This video is for educational purposes only and is not professional financial advice. Do your own research before investing. IREN Limited, ticker IREN, a vertically integrated data center and Bitcoin mining operation that's been on one of the wilder rides in the market, up nearly 19% today alone, sitting on a $14+ billion market cap, and yet the revenue growth just clocked in at essentially 0% year over year. So what's actually going on here? Is this a company capturing a generational shift in digital infrastructure, or is the market running ahead of a business that's quietly stalling out? Over the next few minutes, we're going to dig into the market opportunity, stress test the growth story, look hard at the competitive position, and then ask the only question that really matters for your money. Is the price you'd pay today actually justified by what this company is building? The answer might surprise you, and not necessarily in the way the bulls would hope. Bitcoin mining and digital infrastructure sit at the intersection of two of the most powerful secular forces in tech right now: the institutionalization of digital assets and the exploding demand for specialized, high-density compute. There's no clean number that captures exactly how big that opportunity is, but the direction of the wind is unmistakable. More hash rate, more data center capacity, more capital flowing into this space every cycle. Now look at IREN's revenue trajectory. From $2.24 million back in late 2021, the company scaled to $144.79 million in the most recent quarter. That's a real business being built. But the quarterly pattern tells a more nuanced story. Revenue peaked at $240.29 million in the first quarter of 2026, then pulled back to $184.69 million, and now sits at $144.79 million. That's a downward trend in recent quarters that we'll need to watch closely. Geographically, the business is heavily concentrated. Australia accounts for $484.63 million in revenue versus just $16.39 million from Canada. That's not diversification. That's a single market dependency. It's a risk worth naming now. Can IREN re-accelerate from here? Or is the recent revenue slide the beginning of something more structural? Here's the thing about IREN's growth story. The headline numbers are genuinely impressive until you look at the direction they're moving. The acceleration signal on this company is decelerating, and that matters more than people give it credit for. Cast your mind back to where this started. From Q4 2021 through the first big surge, year-over-year growth rates were explosive. 453.8%, then 175.4%, then 205.7%, then 376.3%. Those aren't normal numbers. That's a company going from nothing to something at tremendous speed. But here's where it gets complicated. The most recent year-over-year growth rate? 0%. Flat. Revenue in Q3 2026 came in at $144.79 million. Essentially identical to Q3 2025's $144.82 million. After the peak of 355.4% year-over-year growth in Q4 2025, the deceleration has been sharp and rapid, down to 59%, and now effectively nothing. The central question you have to answer is this: is this a tough comparable period after an extraordinary run, or is the growth engine genuinely losing steam? Australia is doing the heavy lifting here. Canada barely registers. That geographic concentration means there's limited diversification to cushion any regional slowdown. No meaningful peer comparison exists for IREN in this analysis, so let's do something more useful. Hold the company up against itself and see what the fundamentals actually say about durability. Start with gross margin, 68.3%. That's a genuinely strong number for an infrastructure-heavy business. But it's compressing, down 3.6 percentage points over 5 years, and the direction of travel matters as much as the level. A compressing margin in a business that's still scaling is a yellow flag, not a red one. But it needs explaining, not ignoring. Then there's the Rule of 40 score, -57. The Rule of 40 combines revenue growth and profit margin. A healthy growth company should score above 40. -57 means the combined score of growth plus profitability is deeply underwater. That's not a rounding error. That's a business model where the economics haven't yet caught up with the ambition. Free cash flow? Burning cash. The business is not self-funding its growth right now. The revenue momentum chart reflects what we saw in Scene 3, a dramatic climb followed by a visible rollback in the most recent quarters. Quarterly revenue has been choppy, not compounding smoothly upward. Here's the honest verdict on competitive durability. The gross margin suggests IREN has real pricing power within its niche. But the Rule of 40, the cash burn, and the margin compression collectively say this is a business still fighting to prove its model, not one that's already won. Start with history. IREN's price-to-sales ratio has swung wildly, from 218.3 times in mid-2021, collapsing to 2.3 times by 2022, then gradually climbing back to 6.7 times in 2024 and sitting at 6.2 times today. The early multiple was pure speculation. The current 6.2 times is far more grounded. But is it the right price for what the company is actually delivering right now? That's where the valuation meter becomes telling. The price-to-sales-to-growth ratio is negative 322.76 times. In a healthy growth stock, you want this below 1, meaning you're paying less than 1 times each percentage point of annual growth. A negative reading here reflects the fact that year-over-year revenue growth has hit 0%. The market is paying 6 times sales for a company that isn't growing right now. That's a real tension, and it doesn't resolve itself just by hoping the next quarter bounces back. Now, Wall Street doesn't fully share that concern, at least not yet. The analyst consensus sits at buy, with 10 buy ratings against 3 holds and 1 sell. That's meaningful conviction from the sell side. And the price targets? The lowest analyst target is $50. The average of all analyst targets is $82.17, and the highest sits at $99, against a current price of $39.90. The average target implies more than 100% upside from here. The bulls clearly believe the growth reaccelerates. The question is whether you're willing to bet on that before the evidence arrives. 4 risks and 4 catalysts. Because with IREN, there's genuine substance on both sides of the ledger. Cash runway is the most urgent risk. IREN is burning $93.9 million per month, with roughly 2 quarters of runway remaining. That's not a distant concern. It's a live pressure point that could force a capital raise on terms that hurt existing shareholders. Growth deceleration is the second risk. We've watched year-over-year revenue growth fall from 355% to 0 in just a few quarters. If that's not a bounce, it's the beginning of multiple compression. And a 6 times sales multiple is hard to defend with flat growth. Multiple compression risk sits right alongside that. IREN trades on narrative and momentum. Any shift in macro sentiment, risk appetite, or Bitcoin's price cycle could reprice this stock sharply lower, independent of anything the company does operationally. Dilution is the 4th risk. A company burning nearly $94 million a month with 2 quarters of runway almost certainly needs to raise capital. More shares at a discount means your stake gets diluted. On the catalyst side, a Bitcoin price surge would directly lift mining economics and revenue. Infrastructure expansion into high-demand AI compute could unlock an entirely new revenue stream. Resolution of the runway issue through a clean capital raise would remove the overhang. And any quarter that shows re-accelerating revenue growth would validate the bull case and likely reprice the stock significantly higher. Here's where we land. The bull case for IREN is real. Strong gross margins, a massive analyst price target averaging $82.17 against today's $39.90, and a structural tailwind in digital infrastructure that isn't going away. If Bitcoin runs and the company nails its next capital raise, the upside is genuinely significant. But the bear case is just as real. Revenue growth has hit 0. The company is burning $93.9 million every single month with roughly 2 quarters of runway left. The Rule of 40 score is negative 57, and the current price-to-sales multiple of 6.2 times demands a growth story that the most recent quarter simply didn't deliver. Remember that deceleration signal we flagged in Scene 3? It hasn't resolved. It's gotten worse. The market pricing today reflects hope for re-acceleration, not evidence of it. The verdict? Avoid. Not because the story is over, but because you're being asked to pay a growth multiple for a company that isn't growing right now, while it's burning through cash at a ferocious pace. Watch the next 2 earnings reports closely. If growth comes back, the entry point will still be there. Subscribe for the follow-up when the numbers change.